Hi, this is Joe Duffey with Evers Financial. I'm here today with two of my compadres in the retirement plan industry, Aaron Wiseman with Lincoln Financial Group and Leslie O'Brien with Benefits Administrators, and we're going to have a little back and forth discussion today about the CARES Act and the Secure Act. You guys want to introduce yourselves?
All right, again, Aaron Wiseman with Lincoln Financial. I've been with Lincoln in this Ohio, Kentucky area for about 10 years.
I'm Leslie O'Brien. I'm with Benefits Administrators. We're an independent third-party administrator of retirement plans located in Lexington, Kentucky. We've been in business 25 years this year and serve over 900 business owners.
Wow, that's fantastic.
Thank you.
And a great partner of ours.
Oh, absolutely, absolutely. She does a phenomenal job. So we wanted to talk a little bit, and Leslie's been talking a lot about the CARES Act and the Secure Act, and we really want to look at it from three different perspectives: from the perspective of the plan sponsor, the HR person at the company that would be taking care of the plan, and the participant. So Leslie, tell us a little bit, from the plan sponsor's viewpoint, what effect has the CARES Act had?
I think the biggest effect to the business owner or plan sponsor has been the waiver of R&Ds for this year in the CARES Act. So certainly R&Ds normally are happening towards the end of the year for those who are of age, and across the board we do not have to implement those this year. So that does require a plan amendment or documentation of that by the plan sponsor, so certainly that's something they'd want to discuss with their administrator about too.
Okay, and then what other things would the plan sponsor want to know about the CARES Act and how it might affect their plan?
The other ways it'll affect their plan are some optional distribution options that are now available. And with CARES came out two major distribution options. The first one is a coronavirus related distribution, acronym CRD, oftentimes in the industry you'll see. And that allows a participant to take a distribution of up to $100,000 anytime this year and waiving the 10% penalty even if they're under age 59 and a half.
And the plan sponsor does not have to necessarily put that in effect. It's up to them.
That's correct. Each and every plan in the country is going to make the choice if they want to allow that distribution option to be available.
And from your perspective and your clientele, do you see more people implementing it or not implementing it?
I would say not implementing it right now. Less than 20% was the last study I saw last week of small businesses. I think plans 10 million and under were surveyed in that one. Really, it's been industries that have been hard hit. Tourism, restaurants, we've seen it more in those sectors than we have in other areas at this point.
And Aaron, from Lincoln's perspective, do you think Lincoln has seen more of their plans implement these distribution options?
At first, I thought when the regulations first came out, I thought it was going to be more prevalent than it was, but I would agree with Leslie that we've had, it might even be less than 20% of folks take part in that. Yep.
Great. All right. So let's talk about the HR people. What do they need to be concerned about?
The HR people are generally focusing on those employees and what do they need. And so do they need coronavirus related distributions? Has someone been impacted in their world where this would be an option for them, right? Has someone been diagnosed with the virus, a spouse or dependent? Or have they had an hours reduction at work? So maybe the HR person knows that they've had to reduce hours for some of their workforce. And so this CRD option might be a good option that they would want to advocate for to add to that retirement plan.
That brings up a good point, verification. What does the HR person need to do as far as verifying? Let's say I'm the participant. Maybe I had a really bad cold. Maybe I didn't go get certified that I had, coronavirus. How do they verify?
So the legislation was actually written that it's self-certification, meaning the employee is certifying and they're taking the tax ramifications on themselves by saying, I did have an incident related to this. So unlike in a hardship distribution in a 401k plan where we have to get documentation from the bank if I'm buying a house for a down payment or things like that, in this particular case, the participant's certifying. And generally, the record keepers forms have included that self-certification language, so when the participant is signing it, they're certifying that they have met one of the criteria. So.
Gotcha. Okay, participant. What does a participant need to know? What do they have to go through as far as the CARES Act?
I think the participant would certainly want to know that they had one of those qualifying events. They would want to understand what they're signing.
Okay.
I think the participant would always be interested in knowing too, what are my tax ramifications? Because I'm going to owe tax on this money. Certainly we mentioned the 10% penalty is waived, but they also in the bill allowed the taxation to be spread across 3 years. So a third, basically. And then anytime in that 3-year period, they have the ability to pay all or part of that distribution back. So that would then reduce the taxes in the following years that they had to pay as well.
So I want to back up real quickly too on the waiver of the 2020 RMDs, required minimum distributions.
Yep.
So the government passed the act, don't have to take them.
Yep.
So what if somebody, they're in it, they still want to take it? I assume that that's not a problem.
It isn't. They certainly can choose to do so. It would once again need to be documented with their administrator because the amendment to the plan will need to be drafted in that manner.
Okay, and everybody has to do a plan amendment in order to waive the RMD.
Yes, they do. Though strangely enough, the amendment is not due until December 31st of 2022. So they've given quite a bit of time to actually draft and sign that amendment, but they do need to document operationally what they've done so they can get that amendment drafted when it's available.
Okay. Any other thoughts on CARES Act?
The only other major piece was the coronavirus loans. So it did allow, if a business owner wanted to amend the plan to allow a larger loan balance available to an employee from $50,000 to $100,000, they do have the opportunity to do that, as well as potentially waive loan payments between now and the end of the year. So that was probably the other most.
And how long will these be available?
The heightened loan amount of $100,000 is available till September 27th of this year only. So it's 180 days from the bill signing, which was actually March 27th.
Okay, all right. Well, let's switch gears a little bit, guys, and talk a little bit about the Secure Act. And I don't know how you feel about it, but to me, the Secure Act is just a lot more to it.
Yes.
A lot more to it. So let's start with from the plan sponsor viewpoint. What are the key points, Leslie, that the plan sponsor needs to be aware of with the Secure Act?
So once again, we had RMDs in the Secure Act, but what it did instead of delaying payments was raising the age from 70 and a half to 72. So that was the most expensive piece of this legislation that went through in this act. So that's been a wonderful thing because people are living longer.
Yeah.
And so it's allowing them a little extra time before they have to take money out of those retirement accounts.
I've been doing this, working with plan participants for 30 years almost, and I definitely have more people that would rather not be forced to take money out than would rather take it out sooner. So now, before with the CARES Act, there was a plan amendment with the RMD. Does this require a plan amendment also?
It does. There is an amendment for the Secure Act as well. It is also due December 31st, 2022. And there are various provisions in the Secure Act that could be effective based on what you want to amend your plan to permit. So.
Gotcha. Okay. If there's something about the safe harbor non-elective provision.
Right, so testing. In a 401k plan, we often have discrimination testing, and it can be challenging to pass based on the participation of the employees. And so one of the remedies is a safe harbor plan design. And it's always had in the past, it has to be adopted prior to the year starting. So you never know if you're going to have trouble with testing. We're just guessing, or maybe we had trouble in the past. And now someone can adopt that mid-year. They can pick up the phone and call and say, I know our workforce has changed with all of this going on. We know we're going to have trouble with testing. Let's amend the plan and give 3% across the board to everybody. And they can do that anytime between now and November 30th. If they're willing to do 4%, they could extend that until March 15th of next year if they'd like.
Okay, good. The death RMD distribution.
Yes, and you and I were talking about that a little bit earlier, and the way the R&D age increase was the most expensive part of the bill. So then the question became, how did they pay for it? And so paying for it became, we have to get that money for that deceased person out of the retirement plan within a 10-year span. So I'd love to hear your thoughts on that and how that's affecting your clients.
Well, not favorably. I mean, obviously, most of the clients feel like, look, I paid the majority of my tax through my lifetime. If I could leave something to my children, fantastic. I don't have anybody that comes to me, and it's like I tell my clients, financially speaking, you know that it'd be best for the children to spread that taxation out over their lifetime.
Mm-hmm.
But statistically speaking, do most children do that? No. Not usually.
Yeah.
But now, it is what it is. Some people will, some people won't. We hope that they'll listen to our counseling and spread that out, but, in a lot of cases they don't.
Is that impactful to your industry, Aaron, where they're having to move that money out quicker? Do you see that changing things on your side?
I really haven't, to tell you the truth. It hasn't, I haven't seen an effect.
Okay.
So let's talk about the lifetime income options.
That is definitely Aaron's wheelhouse.
So we have, well, you and I are aware of this, right? A year and a half ago, we sat down at the table with a client, and one of the comments that we had during that lunch, or one of the questions I had asked him was, to the gentleman is, what were you thinking about knowing that you were going to discuss your 401k plan, at lunch here? What was going on in your mind? And one of the first things he said was, I really want to protect my employees' income. I'm really worried about them losing their money, right? And how great does he feel, on March 1st or a year and a half later, with some of this market volatility, knowing that his employees' 401k retirement assets were well taken care of.
Secure.
Right? Were secure.
Yeah. I really think, this has been, obviously I don't have a bend one way or the other with my clientele about, whether I think they should put their money in a managed account or whether it should go in, partly managed, partly mutual fund, partly annuity. But I definitely think there's always this portion of your money that needs to be secure. There's got to be a portion of your money that you can look at your spouse, you look at your loved one and say, I know that this is a piece that's going to last the rest of our life. No matter what happens, this piece is going to be there. So I really think the lifetime income option, and I think the greatest thing the government did is they shined a light on and said, hey, people, you got to be concerned. These annuity options. And I know President Obama was not a fan of 401k plans per se because he felt like this lump sum distribution just wasn't working. And I think in a lot of ways he was correct. You got to at least have an option to where people can. Look at lifetime. Look at these target date funds. How they've come on like wildfire. Are they so much better performance wise? Not necessarily. But they take the onus off the participant from having to make these decisions themselves. And I think this lifetime income option does the same thing.
And it's evolved, right? I think some of the misconceptions in the last several years with respect to lifetime income was, one, that it wasn't portable, right?
Right.
And that, if a business owner decided to change record keepers, that they would lose the income, or they would lose the income feature, and then they would have spent money for an income feature for nothing.
Yeah,
essentially. Right? That's changed. I think another misconception or another obstacle to lifetime income in the past, which is Lincoln has worked to fix that inaccuracy, was it was all or nothing. And if you had an employee, right, potentially a blue collar worker with a $40,000 account balance, they ought to grow their money too, not just protect or not just guarantee that $40,000 balance. And again, Lincoln has worked to improve where you can grow, as with our mutual client there, was to grow your assets and guarantee them someone at the same time there. So it has evolved, and I'm glad to see it in the Secure Act.
Yeah, me too. Good stuff. I think that the government really did some good things with this act.
We did.
Let's talk about the tax credit for installing a new plan.
Absolutely. Startup plans are now having the availability to have a tax credit of up to $5,000 for the first 3 years that their plan is implemented. And that allows them to offset my cost, Lincoln's cost, as well as even potentially yours as the advisor. It could be all three of us, so that then not only are they taking a tax deduction as they always have for those expenses, but now they get a tax credit on top of it. So it really does help a plan get started. That's the hope, right?
Yeah,
I think
right.
with this act,
Right.
is let's see some new retirement plans get started in small businesses.
So, quick question. Let's say a client had a simple IRA plan. and now they want to switch from a simple IRA plan to the 401k plan. Do they get the tax credit?
Well, if they took advantage of the prior tax credit, which was limited to $500, they would not be able to do so.
Okay.
If they had not, some simple IRAs may not have, just due to the fact that there's really not a lot of chart billables in a simple IRA oftentimes. So they certainly want to talk to their CPA.
And there's a tax credit also if they were to add automatic enrollment?
Yes, and this one's interesting because you can apply it to existing plans as well as new plans. And so now you could take advantage of an additional $500 if you're just willing to implement auto enrollment. And they don't mandate a certain percentage, so they could start at 1 or 6, whatever they wanted to do, or anywhere in between.
Fantastic. And is all this stuff, these kind of changes, again, are there, do we have to do amendments to existing plans? If we're changing anything, there's got to be an amendment for it, right?
Well, the startup tax credits, we don't have to amend. That's probably the one exception. Those are the exceptions to that rule. Otherwise, the R&D ages, the safe harbor, the lifetime income options may want to be listed because maybe we're going to do annuity or installment payments. So those may be impactful to that plan design.
And then you have a note on here, deadline to adopt retirement plan filing of tax return with extensions?
Yes, so you used to have to start a retirement plan by December 31st in the calendar year you wanted to start it. So December 31/19, if you wanted a plan, you had to sign it by that day. Okay. Well, now in 2020 and moving forward, you can pick up the phone and call me in February of 2021, March of 2021, and say, I'd like to start a plan for last year. And I need one. I didn't realize I made so much money. My tax liability is so large. I need to deal with this in a constructive way. And how do I do that? So, and that does include with extension. So technically you could get up into mid-September of next year and set up a plan for the prior year. So it allows hindsight for that business owner to determine what's the best plan design. And that would include profit sharing, defined benefit plans across the board.
So Aaron, you guys haven't always offered the lifetime income option. So if somebody was with Lincoln, let's say they've been with you guys for 10 years, they're on an old plan design, they want to add lifetime income, can they do that?
Yeah, I mean that is as simple as moving to a more updated platform.
Okay.
Which we tend to do, maybe every 4 to 5 years, right? When a new platform comes out, certainly we'll look at repricing, adding what features to take advantage of what's happening today.
And I assume if those assets were at one of your competitors, you would take that too?
I absolutely. That's a little easier to do, actually.
All right, let's talk about the Secure Act from the HR department's perspective. What do they need to be concerned about, Leslie?
I think the HR's perspective, once again, there is the ability, if a plan is a safe harbor auto enrollment plan, you can have always been able to have escalation in that auto enrollment, but now we can go allow the employees, push them from 10 up to 15%. So HR can really see, do we need to have the workforce save more to be healthy at retirement, have a healthy and substantial lifestyle, much like they do while they're working? The other thing I think that we have seen is there's a new distribution option available under the Secure Act for the birth of a child or the adoption of a child. And so sometimes in the workforce there may be a need whether either parent would need to take some money out to cover costs as this new person has entered their family. And that's a wonderful option to maybe look at adding for that workforce. The HR department may be interested in offering that too.
And you and I talked about this before, the QACA.
Yes.
Which is so ironic because I really, like I told you, doing this for 30 years, I don't have one plan that does QACA.
Yeah.
But we actually, Aaron, we'll be working on a plan. And in meeting with a guy, we were talking about, what is his plan design like? And he mentioned this strange formula, and I'm like, I think you got to be wrong about that. But no, it was a QACA design. So talk about the QACA, the deferral percentage. That's, as far as my understanding, that's been increased from 10 to 15%?
It is. And so that does allow, the QACA will allow a plan to offer auto enrollment and be safe harbor, so pass discrimination testing. And with that, the matching formula that you use is a little different than a traditional safe harbor 401k. It's dollar for dollar up to the first percentage. and then it's 50 cents on the dollar between 1 and 6 or 2 and 6.
Yeah.
So 3.5% match in total, but it does allow the ability for the plan sponsor to kind of push that match formula out to that 6% level, whereas we're more at the 5% level in a traditional 401k plan.
Okay, good stuff. Now let's talk about the Secure Act from the participants' viewpoint. What do they need to be concerned with, aware of?
I think the adoption and childbirth amendment could potentially be something they may want to advocate for. I think the lifetime income options are certainly, from a participant's point of view, hugely impactful. The other item that might be impactful to them is in-service withdrawals at age 59 and a half on defined benefit plans and money purchase plans. So traditionally you had to be age 62, so if you have that old type of pension plan that you were used to, but you're still working, but you might need to access some of those funds, it's possible for that plan sponsor to amend their plan and allow that to happen at age 59 and a half now, much like a 401k.
Now we know that we talked before already about the RMD age increasing from 70 and a half to 72. Just refresh people's memories. If I am working and I'm participating in my 401k plan and I'm 70 and a half, do I have to take RMDs?
As long as you were not 70 and a half by December 31st of last year, you are not required to take RMDs until you're age 72.
Perfect. All right. I guess, we talked a bit about the lifetime income options. Obviously, that's a big deal for participants to be aware of. Disaster tax relief.
That falls under the hardship provisions.
Okay.
So if there were a large event such as a tornado, hurricane, something of that nature, hit your home, it does allow for the 10% penalty to be waived on a distribution related to that. So that alleviates the tax burden in a situation where you're already having such traumatic financial difficulty.
And refresh my memory. When did the Secure Act go into place?
It was, I believe, December 21st, 2019, and right before the holiday season.
Okay,
Something
all right.
along that line there. So, yeah.
Because I know there's this thing about long-time, part-time employees becoming eligible to be in the plan, but I believe it's a 3-year.
It is. That actually starts next year. So they gave a little bit of lead time for business owners to adapt their plan design and determine and being able to track these employees. So traditionally, a part-time employee who worked less than 1,000 hours wouldn't be eligible for the 401k plan, oftentimes based on plan design. Well, they lowered that minimum to 500 hours in 3 years consecutively. So if an employee works at least 500 hours for you in 21, 22, and 23, effective 1/1/2024, that participant would now be eligible for your retirement plan. The one thing I will say is if you do have concerns about that plan design option, or maybe it's expanding the workforce or difficulty in tracking, please reach out to the advisor, to Lincoln or myself, and we're happy to talk you through, because there are some plan design options we could tweak potentially to minimize the impactfulness of that. So, but expansion is good. That's what this bill was about, right?
Absolutely.
Expanding retirement.
Making retirement more available to more people. I look at most of this stuff and I think about time.
Yeah,
Common sense improvements.
absolutely.
Well, thank you both for coming. I appreciate it. I think this will be educational for a lot of people.
Thank you, Greg.
Hey, Joe.
Thank you.
Good job.